I think bond yields are going to rise 100, 150 basis points by the end of 2018. But we've just watched bond yields fall 40 basis points in the last 3 months. So how do I feel about that, and how am I going to work with that? For me, we're focused on that medium-term outlook. So first we've got to try and work out if we're right and what has caused this rally for the last 3 months. When we look at it, it's quite clear. We've had 5 downward surprises in inflation. We've had hurricane concerns. We've had North Korean tensions. So we have to navigate that in positioning for this medium-term view. We've also had Trump disappoint on the tax cuts. So that explains what's happened. So why can I be confident looking forward for the next 12 months what's going to happen? Well, we've been doing a lot of work on the inflation outlook and on the QE outlook, as well as the tax package. So taking that in order, when we look at what's happened with inflation in the last 5 months, we've actually had a confluence of the currency lagged effects, the energy lagged effects, housing cycles and administered prices all coinciding in this window to push prices down. We can actually forecast all of those components reasonably comfortably looking forward. And 4 of the 5 we've actually got rising by 0.5% in the next 6 months. So that's going to change the dynamics very clearly as we look at the inflation rate and the levels of bonds going forward. Secondly, we've got a lot of QE going to start unwinding. At the moment, when we look at global bond purchases by central banks, it's running at about 100 billion a month. That's 50 billion from the ECB and 50 billion from the BOJ, US dollars. The Fed's not doing anything. But we know the Fed's about to start selling bonds or winding down their bond holdings as of September. We know the ECB's probably going to start in January and probably be complete by September next year in 2018. So the flow of purchases of bonds is going to drop from 100 billion today to 0 in, say, 12 months' time. On our work, that says yields will rise about 90 basis points. Most people think that's going to happen over the course of 6 years because they're focused on stock of bonds, not flow of bonds. So we get yields 100 to 150 basis points on those 2 factors. So how do I hold that view when yields are rallying 30, 40 basis points? So the key is not to lose too much money while you're trying to stay in one of those medium-term ideas. It's capital preservation, so you can play for that theme as it starts to develop. So that's what we're doing. We have on medium-term structured trades in the options market across the US rate curve over different time frames and looking for different size moves. But we protect it by putting on trades in dollar-yen, for example. Yen is 70% correlated at the moment, 76% actually, with US 10-year yields. And the yen-vol market has a panic skew in there for North Korean tensions. So we can get a great risk reward for putting a range trade on dollar-yen or even slightly lower in dollar-yen that protects our 10-year view. And so if nothing happens or yields rally a little bit, we're protected. We can do the same on the Korean won. And if we're really worried about something happening, we can have calls on gold, which we've been doing. So we build all these insurances into the portfolio so as to protect the capital and let us hold on to that medium-term view whilst we have these tensions.